Avni Raja and welcome to another episode of Investor's Guide, where we help you and guide you on how to make your money work for you. Joining me as always is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thank you so much for joining us on yet another episode of Investor's Guide. Now, last episode we started talking about debt funds and talking about the various kinds of debt funds. Today we are going to start talking about duration funds specifically. And duration funds, if you look at it, it gets categorized into different aspects as well. You've got the medium to long-term duration funds, the short-term duration funds, and the ultra short-term duration funds. Now, all of them have a different place in one's portfolio. So today we'll start by talking about the medium to long-term duration funds. Feroze, as far as this category of funds are concerned, if you can start off by explaining how this works, and there has been some recent recategorization as well of late, which has sort of put income funds now into this category as well.
Yes, Avni, duration funds are those funds which actually have a larger duration, as the name suggests. So medium and long duration funds are nothing but income funds, where the fund manager buys a bond, he or she buys a bond, holds it for a medium period, like 4 to 5 years, then it is a medium duration bond fund. The fund manager's objective is to buy the bond, relish and enjoy the interest which those bonds pay to the pool, and then pay as dividend to the ultimate investor of the mutual fund, or grow it and reinvest it. So duration fund is nothing but a fund in which the fund manager is mandated to buy bonds, hold them ideally and not trade extensively, unlike in a dynamic bond fund. And the medium duration is generally between 3 to 5 years. And the long duration bonds, long duration mutual funds will generally have 7 to 8 year kind of maturities of the bonds which they end up buying.
Okay, so in terms of how these funds work, if we can just understand a little better with respect to interest rates and how the fund manager's role in this category is especially important.
With respect to interest rates, when you buy a bond, let's assume you've bought a bond of 5 years at 8%, and so the interest is 8%. Let's assume the fund managers put 100 rupees into a bond which has an 8% interest for 5 years. If interest rates go down, this bond will now be very precious because it's locked in an 8% interest rate. If the interest rates go to 6%, this bond will start quoting at a price greater than 100. So this phenomena is called interest rate risk. Why is it important to understand? Because if you to understand the role of the fund manager's key role is to manage the risks which are there, which are associated with the investing of that specific fund. So interest rate risk is one thing which the fund manager manages, which is nothing but the change in the price of your mutual fund, which is nothing but a bond portfolio with change in interest rates. If interest rates go down, your bond portfolio price rises. On the contrary, if interest rates rise from 8 to 10%, like in this example, then the bond will no more be valued at 100, it will start quoting at 98, 97 instead of 100. This is called the interest rate risk. So it's very important if you go into duration funds, understanding interest rate risk is a very, very important thing to do. That's one. The second thing, which is another very important risk when it comes to investing in debt, is credit risk. When you buy a bond and the corporate or the company whose bond you bought is not capable to repay the money. So the fund manager's role, Avni, is to manage the interest rate risk and the credit risk and buy good quality bonds which give a very good interest but have a very low risk of going belly up or bankrupt or not paying your money back. So that is the most important part of the role of a fund manager in these debt funds, duration funds largely. In most debt funds, these are primary objectives of the fund manager.
Okay. Right. So, Feroze, the question also then arises as to where does this fit into one's portfolio? Because yes, it is the debt category, but it doesn't mean it doesn't come with its own set of risks. So, how does an investor sort of categorize this and fit it into one's portfolio?
The duration funds especially have the capability of locking in interest rates. So these are very good when the interest rates are expected to fall and go down over the years. So they, in the contemporary situation, have a reasonable role to play in one's portfolio because interest rates are today going lower and are expected to further go lower over the next few years. So that's very important. So it should form at least 10% to 15% of one's overall portfolio. Okay, if you have 100 rupees, out of which 40 rupees is invested in debt, you take 1/4 of that, which is 10 rupees, and invest in a duration or a medium duration fund. Will make so much sense from a contemporary interest rate correcting phase, which we see ourselves. So that's very important. The second is that the diversification of these portfolios is reasonably large, which in turn brings down your risk and gives you that stability and that sleepful nights when you invest.
What kind of risks are we talking about here? Because this is obviously keeping in mind interest rates and how interest rates are moving. So given the current scenario we are in right now in India, we are looking at falling interest rates, perhaps further going to come down going forward as well. How should one approach these funds, and what are the kind of risks we're looking at?
To risks, like we just spoke of, there are two risks, but it's very important for an investor to understand the numerical values of those risks. For example, today, if you have a mutual fund portfolio of debt categories of about 5 debt funds, the ones which we recommend, especially the model portfolio which Anand Rathi recommends, can give a range of return, not a return which is exactly 6 or 6.5% like a fixed deposit. A debt fund, a group of debt funds will always have a range of return. So if you choose them wisely with a complementary nature, a few dynamic bond funds, 1 or 2 medium duration funds, or 1 or 2 short duration funds, if you combine all of them, then you can have a range of return from 5 to 7.5, 8. So that's the risk we are speaking of. We are not speaking of a capital risk like in the equity. So the difference of the return which you may end up getting over the next 3 years could be about 3%, 5 to 8% per annum. So that's the numerical value of the risk you'll have to prepare yourself for when you buy a mutual fund portfolio in the debt category with a mix of a few categories.
Okay, and when we talk about the taxation as far as debt funds are concerned, what would be the tax implications for investors?
The tax implication for investors in debt funds becomes very low, or becomes more lucrative for one to invest in these debt funds and stay invested for 3-year periods. So after 3 years, you have a long-term taxation, which is at 20%. Along with that, you get an indexation benefit. So the average taxation could be 8 to 10% only from a 3-year holding. If you sell a debt fund, any debt fund, before 3 years, which is 1,097 days, you will have to pay the marginal tax rate. Marginal tax rate is nothing but the rate at which you pay taxes for the rest of the income you made in that financial year. So taxation is very efficient after 3 years, before which the tax is as per the tax slab of that current financial year in which you've done sale of these debt funds and realized profits from it.
All right, Feroze, we'll leave it there. Thank you so much for joining us on this edition of Investor's Guide. For our viewers, I hope this has helped you understand what these duration funds actually mean and how they fit into your portfolio. On the next episode, we'll continue with talking about duration funds, but we'll shift focus to talking about the short-term duration funds, how they work and how they would fit into your portfolio. That's going to be on the next episode, so do tune in for that. Until then, thank you so much for watching.